Restaurants will enter 2023 with slowing inflation, but an uncertain economic outlook that may weigh on sales. Let's get a restaurant sector outlook with Jefferies Managing Director Andy Barish. Andy, always good to see you. Let's start with Starbucks. I know it's a name you have been publishing on throughout the year, of course, and more recently. What's the outlook for Starbucks?
Yeah, I mean, Starbucks, we did downgrade here recently as we look out to 23. I mean, we think the holiday season is going to finish up strong for Starbucks and for the industry for that matter. But as we look out towards moving through 23, Jefferies economists and forecasts have gotten a little bit more negative in terms of looking for the recession in the back half of the year. So we've reflected that in our same-store sales estimates for Starbucks late in their fiscal 23 and into fiscal 24. As consumers may pull back a little bit more on those discretionary kind of afternoon occasions and treats and things like that, as we've seen in past cycles. Not a major change, just one where the stock has had a big run right to our target price. And expectations, I think, are fairly high given the growth algorithm that was set up by the management team in mid-September at their analyst investor day. So there isn't a lot of room for disappointment, and we think the company's in terrific shape, but the stock is pretty fairly valued here.
Now, that cup of coffee, that, beauty product and the makeup, things like that are typically looked at as some of the little luxuries when there is a pullback in some of that consumer discretionary spending. Does that mean that little luxuries, perhaps ahead of an impending recession, and to what extent we actually see that recession roll out, does that mean that those little luxuries are actually perhaps in peril, or at least on the chopping block for a lot of consumers?
It's a good question. We really haven't seen any signs of that, thus far. So what we're, reflecting in our modestly, more defensive view going into 23. Now, we still like a lot of stocks and a lot of parts of the industry. And, we think experiences are going to be something that continues to be popular in 23. We do think the industry overall is a little bit misperceived in that they are grouped in consumer discretionary, but have much more staple-like demand characteristics. And we believe that that will show through. Again, our economist has gotten more cautious on the back half of 23 into the first half of 24, calling for kind of a 4 or 5 quarter recession. We don't necessarily model fully off a macro by any stretch, but we did want to kind of, reflect in some areas where there may be a little bit of risk. And again, I think with Starbucks, that brand is so strong. A lot of those rituals, to your point, are going to continue. The question is, at some point, does the consumer pull back or just go from spending a lot of money on a venti to a little less money on a grande, which may have an impact on check average, for example.
Andy, what about full service versus casual? Because I know you write about that a little bit in your note as well, that full service has been relatively strong because people are getting back out there. They want that full service experience. But how is that going to fare if we start to see some more of an economic pullback?
Yeah, thanks for that question, Julie. I think it's an important one, and it is a big investor debate out there. We continue to like most of the full-service casual dining companies. We did downgrade a couple of names, Brinker International and Red Robin, a week or so ago, just in that they're a little bit more in turnaround mode and exposed to kind of a little bit higher percentage of lower end consumers, if you will, which has been where we've seen weakness on the margin. But generally speaking, the casual dining industry has come through, to your point, in very good shape. And there's a lot less capacity than there was in the pre-pandemic period because of the challenges. So we think that industry is going to be the surprise industry, even if we do see a recession starting in the back half of the year. We don't see a lot of flex to the downside in those models. And again, they've kind of proven it over the past few years. They can flex expenses. They can find efficiencies. They've added a permanent layer of off-premise sales. So we think those casual dining business models are actually in really good shape. The balance sheets are in better shape. They're generating free cash flow going into 23, even if the economy gets rockier. And there's been companies that have proven it, like Darden and Texas Roadhouse, which do carry good multiples. And we think some of the other names, some of our favorites like Bloomin' Brands and Dave & Buster's, can start to move up and re-rate higher towards those premium multiples that those other companies carry.
And it just feels like a trip to the casual dining restaurant, Olive Garden, Outback, Bloomin' Brands, you name it, all those names. It feels a lot more expensive. And of course, these places have had to raise prices because of their own higher costs of labor. Are you hearing anything from the industry players that they might have to go back out and start discounting more to kick off next year?
Yeah, again, really good point. On the margin, we're not hearing that. And again, we're not seeing the consumer trade down. Now, 23 may be a different year as the calendar turns and people get through the holidays and realize that the inflationary pressures have been a bit of a challenge on personal balance sheets, et cetera. But I think it's going to be more contained and done in a way that is not a deep discount, but may spurn some consumer interest. And Darden, with its Olive Garden brand last quarter, was probably a pretty good example of that. They went back to their never-ending pasta bowl promotion that's been tried and true, had not been used during the pandemic, but they did it at a price point that was $3 higher than in 2019, and it worked very, very effectively. So we think the customer has kind of embedded higher cost of dining out into their budgets. And we think we'll still seek out those occasions as we move through 2023.
And now I'm hungry. Andy, good to talk to you. Jefferies Managing Director Andy Barish. Happy New Year, Andy. Good to talk to you as always.